In this video, I'm going to break down risk to reward and win rate and why I believe so many traders, even advanced traders, have a really incorrect way of thinking about what risk to reward actually is and whether or not it inherently provides an edge in the market. We're going to go through some math, some of the basics. Bear with me, even if you've been trading for a long period of time, because I bet you're going to have a different way of thinking about risk to reward and win rate when we get to the end. Before we jump right into it, check out this banner up above me. Use code RDF if you want to support the channel, support me at all your favorite prop firms. Tradeify, straight to funded accounts, 35% off, no evaluation. You could be trading, copy trading up to 5 of them today in a funded account on your way towards a payout. You could also use it at your favorite software companies like TradeZella for journaling and Bookmap for order flow. So let's go ahead and jump right into a chart and we'll start breaking this down. Real quick to break down the basics so we know what we're talking about and we can dig into the more advanced portion of this. This would be a position tool displaying a one-to-one risk to reward. One-to-one risk to reward meaning our risk being 1 and our reward, our target, being 1. They're equal. We have a 25-point stop loss and 25-point take profit on this position tool right here. If we wanted to display what a 2-to-1, for example, would look like, we would have a 50-point take profit and a 25-point stop loss. Our take profit, our reward, is double what we are risking on this trade. If we talk about a negative risk to reward, what is commonly referred to as a negative risk to reward, for example, a 0.5 risk to reward, we are risking more than we stand to make on the trade. We have a 12.5-point target and a 25-point stop loss. So again, just the basics here, bear with me because we're going to dig into what this means and go through some examples. Picture we have 100% random market conditions, which we know we don't. Markets trend, specifically US indices, but I want you to picture markets move an equal distance up and down. And I want you to picture that we are trading in an environment where there are no commissions, no fees, no spreads, nothing that would eat into our profit at all from our entry to our take profit or our stop loss. If those conditions were true and we entered randomly with a 1-to-1, randomly meaning we entered buy or sell completely random, we should end up over a large enough sample size at a 50% win rate. We should win as much as we're losing and we should end up break even. The break even win rate on a 1-to-1 is 50%. We use a simple break-even win rate calculator. If we are risking 1 to make 1, that would be a 50% break-even win rate. If in the same market conditions, we had a 2-to-1 risk to reward, okay? We entered randomly, buys and sells, even with a positive risk to reward, over a long enough sample size, we shouldn't end up making or losing money. We should end up at break even. And the break even win rate on a 2-to-1, risking 1 to make 2, would be 33.33%. We would be losing more trades than we win, but we should still end up break even in the long run given random market conditions and not giving commissions, fees, spreads, swaps if you're in Forex, anything else that goes into this. The same way that if we ran a negative risk to reward in random market conditions, we would end up with a break even at 66.67%. That would be our win rate over the course of a large sample size, and we would end up not making or losing money. The reason being is that risk to reward in itself does not provide any inherent edge. If you just are entering randomly in a random market, with a positive risk to reward, you aren't going to make money because there is no edge present. There's just the math behind that. You are just setting a starting point for yourself for break even. At a 1-to-1, like we talked about, random market conditions, nothing that would eat into the profit, no fees, swaps, commissions, spreads, anything. Over a long enough sample size, if you hit the button buy or sell randomly, you'd end up about break even. Live market conditions, things do trend. We move in one direction over time. They're trending markets. Also, fees, commissions, swaps, it would eat into that. You would lose money over time. You would probably have different positive and negative variance. But again, this is the cornerstone of what I want to display in this video. You can pause the video now and comment down below if you disagree with what I'm saying here, and maybe you could enlighten me on how risk to reward alone will allow you to provide an edge in the market. But I'm going to continue as to what this means practically, what the equity curve might look like for both of these, what this might mean for you psychologically and mindset-wise. If you have a positive risk to reward, you are naturally going to have a lower win rate than you would if you had a negative risk to reward. The challenge remains the same, that we have to increase our win rate past whatever the break-even calculation is by a decent margin in live market conditions, because we do have to cover spreads, fees, commission, all of these things that go into eating into this. So same way that at a 2-to-1, we have to be increasing over a 33.33%. I don't know that it's any easier to increase your win rate past a 33.33% or past a 66.67%, because you're essentially starting from the same place. You're starting from break even with no edge in the market over a large enough sample size. So for me, I don't think there is a massive benefit to running a 4-to-1 risk to reward or a super negative risk to reward. It just comes down to the individual trader, their style, their preference. What I will say, with a higher risk to reward and lower win rate, the distribution of wins and losses is going to look a lot different than just a 1-to-1 or a negative risk to reward. You're going to incur more losses, but your winners are going to outweigh your losses. You are going to go on larger losing streaks. You're going to withstand more consecutive losing trades. This is all displayed in an equity simulator. We can utilize this. Both of these are free. I'll link them below the video, the break-even win rate calculator and the trading equity simulator. For the example, we're going to look at consecutive losses and consecutive wins. Let's say we have a 3-to-1, just to exaggerate a little bit, risk to reward, and we have a 35% win rate. First, we're going to see if this is profitable. Surprise, it is. But what I want you to look at over here is the max consecutive losses and max consecutive wins. Now, this is random, so as I hit this, these numbers are going to fluctuate a little bit. But this is really relying on your risk to reward and win rate, specifically win rate. Look at how many consecutive losses you would have to withstand with a 3-to-1 risk to reward and a 35% win rate over a 500 sample size of trades. A large amount. You could easily say it would be wildly uncommon to not go on at least an 8-loss losing streak. If you inverse this, for example, and we go with let's say a 0.7-to-1 and a 75% win rate. First off, let's just take a look and see, is this profitable? It is. But look what happens over here to the max wins and max consecutive losses. You greatly decrease the consecutive losses and you greatly increase the consecutive wins, right? Again, I'm being a little bit, looking a little bit at the extreme for this. Let's just lower that number just a little bit. But you can see how that flips. What I've started to talk about in a lot of my content, a lot of my videos, is I'm not a fan of this really high risk to reward because of distribution of wins and losses, the random distribution that you will see over a large sample size of trades. I believe that although this may be very profitable, you may find a system that this works very well for. You may find your ability to increase past the break-even win rate is there. This is going to be very difficult to trade from a psychological and mindset perspective. In my humble opinion, it's going to be very hard to have confidence through the losing streaks that you would have to withstand with a risk to reward like this. As you bring this back in, naturally your win rate is going to go up and you're going to have more green days. You're going to have more consecutive winners, smaller, albeit, but you're going to be able to build confidence in your system, in your approach to trade, and not have to withstand so many dang losses that have you questioning whether or not you actually have an edge in the market. Again, this isn't math. This is my opinion. What I also want to display in this video is that there is a way to be very profitable with a negative risk to reward, the same way that there is with a positive risk to reward. And in my humble opinion, neither one is harder or easier when it comes down to actually creating an edge in the market. Harder or easier when it comes to how it is to trade from a mindset and psychology and whether or not you can actually handle what that random distribution of wins and losses is going to look like. Sure, I will have an opinion there. But as far as whether or not it's harder to increase your win rate 5% past the break-even amount, starting at 50% with a 1-to-1, 33% with a 2-to-1, or 66 or 67%, whatever the number is, with a 0.5-to-1, I don't think one is inherently easier or harder. That's just my 2 cents, my opinion. And the math and the way that the markets move and really my understanding of trading would be indicative of that. There's just not something out there that would say it's going to be easier to make money with X risk to reward objectively, not considering anything else from the trader. So again, what I want to display here, which is really counter to what we hear so much, it's talked about, and the way that I understood it for so long was you have to run a positive risk reward to make money. That's how you make money. Your wins have to outweigh your losses. Your wins have to be bigger. But we weren't really talking about win rate. Nobody was really talking about win rate back then and what we actually needed to do to support that risk to reward. And if we had a negative risk to reward, it was like it's completely frowned upon. Again, in my videos, I have a lot of people commenting that, how that's not profitable. In the long run, it won't be profitable. Here's my counter to that. With a 0.5, the 0.5 to 1 risk to reward, the goal is over a 66.67%. If you're going to trade a trending market, and we're going to start to talk about directional trending markets, and we're going to talk about the direction of the trade that we're going to trade in, that's all fine and well, and I think it does make sense to discuss. But when we first start out the foundation of when we're laying this stuff out, there's math behind it. There's basic math behind it and tools we can use to understand how that basic math works out. And I think it's important to remember that and to understand that risk to reward alone is not going to give you an edge in the market. Just placing trades with a 10 to 1 risk to reward is not going to inherently mean you will make money. You're going to break even over a large enough sample size with a very, 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 very low win rate and a really, really nice positive risk to reward. I hope this video is helpful to you guys. If you have comments, please go ahead and leave them down below. I'm happy to talk to you. If you want to chat in my community, I have a 100% free community where I am active all day, every day, and I trade live here on YouTube almost every day. Code RDF at all your favorite firms. And very, very, very important here, I'm not a financial advisor. None of this is financial advice. I'm just an idiot from YouTube. Grain of salt, everything that I'm saying. Do your own research, make your own trading decisions. Read CFTC Rule 4.41 on simulated trading, which is what I do even in funded prop firm accounts, and the affiliate and partnership disclaimer that says I stand to make money from links and codes in my content, like that code RDF. If you found this video helpful, subscribe, like. I'll see you live on YouTube. I'll see you in the community, guys. Talk to you soon.